Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Patricia Kane. Patricia is a professor of law at Santa Clara University. She's been teaching law for over 36 years. She briefly, must be somebody else I'm talking about. Anyway, she briefly practiced law before she became a professor, and she's a member of the Texas and Iowa bars and provides consulting services to law firms. Patricia is a frequent speaker relating to tax planning for same-sex couples and has written many law review articles on that subject. Now today we're going to be talking about income tax problems of same-sex couples, and we're going to be mostly focusing on California same-sex couples because that's where we're from. I'm a California CPA, and Patricia teaches here in Santa Clara University, also in California. But many of the problems that we're going to be talking about are also shared for unmarried couples, so I hope you'll still want to watch with some interest. Now, before we get started, I want to caution you that we're discussing issues in a very complex area. There's issues we were talking about even just before this show that people still don't know the answer for, and so we're going to do the best we can. It's a starting point for a bigger discussion, and you should get qualified legal and tax advice. Also, again, as I said, we're mostly talking about federal and California standpoints, and California is a community property state. Not all states are. And so viewers in other states should seek advice about their own local laws. So with that, welcome, Patricia. Thank you for joining me today. And I'm going to shorten it to Pat, because that's what she usually likes to be called. Okay, well, let's get into this thing. So last May, this is May of 2010. Today is February 8th, for those of you who are wondering when we're talking, February 8th of 2011. But in May of 2010, the IRS issued a new rule and a chief counsel advice that got a lot of attention at the time and has turned out to be quite important for tax return filing in 2010. And in that advice, the IRS told us that community income and deductions should be split between the partners who are California registered domestic partners. So, can you tell us, Pat, a little bit about how this changed the law and why?
Yes, this all goes back to the year 1930. It's actually been the law for married couples for a very long time. There were two key Supreme Court cases in 1930. Lucas v. Earl that said a couple could not enter into an agreement between themselves to split their income. It would not be recognized for federal income tax purposes. The earner would have to pay the taxes on all of the earnings that the earner made. But 6 months later, in a well-known case called Poe versus Seaborn, they said, well, there's an exception to that rule of splitting income if you are spouses in a community property state. So if the state splits your income, it's mandatory, and you must split the income and the deductions. Now, of course, joint returns came about in 1948, so for married couples, it's not as important to be able to figure out what the split income and deductions are. But in 2005, California extended community property rules to same-sex and opposite-sex registered domestic partners. Now, those are not spouses, but they're fully subject to the community property rules. Many of us thought, well, this is going to be interesting because Poe versus Seaborn is going to require all of these people to split their income and their deductions. The IRS initially resisted. They came out with a different CCA in 2006 that said California RDPs, registered domestic partners, could not split. They changed their mind, and in 2010, they finally agreed with what many of us thought was the law all along, and that is that you must, not only can you split your income, you must split all community income between the two partners or the two spouses.
Okay. Now, this chief counsel advice just talked about California registered domestic partners. So what comes to mind is, what about registered domestic partners in other states, and what about people who are actually same-sex married couples?
Right. Well, the CCA was based on a private letter ruling request that did involve a registered domestic partner couple in California, so that is all that it focused on.
Right.
But since then, the IRS has made it clear that registered domestic partners or married couples, anyone who is subject to a state's community property regime will be covered by this income splitting rule. Right now, that only includes the state of Washington and the state of Nevada, along with California. Those two states recognize registered domestic partners, and they are community property states. All of the rest of the states that recognize same-sex couples either as spouses or spousal equivalents, none of them are community property states. So right now there are only 3 states affected. And even though it speaks to registered domestic partners, the IRS has also made it clear that same-sex married couples in California, California is the only community property state that recognizes same-sex marriages. Those before Prop 8 are recognized by the state, and those that were entered into in another jurisdiction after the passage of Proposition 8 are recognized as having all the rights and responsibilities of married couples, but because of Prop 8, they can't use the word marriage. But the community property rules do apply to all of these couples.
So I guess you can get married in other places when you're a same-sex couple, like in Canada, I think.
Canada, Massachusetts, Iowa, Connecticut, Vermont, New Hampshire. The number of states is increasing.
Right. And so, but what we're saying, I guess, is that if you get married in one of those other states and then you move to California,
you will be subject to California's community property regime.
You will be.
Because of your marital status. If you were married in a jurisdiction that recognized the marriage at the time it was entered into, and you moved to California, even with Proposition 8 on the books, you will be recognized as having all the rights and responsibilities of marriage. Proposition 8, as construed by our California State Supreme Court, is really just about using the word marriage or spouses, the language of marriage, and not about the rights and responsibilities.
This is a very confusing time.
It's a very thin line.
Yeah.
Actually, it's a big line, but it's interesting.
Wow. Okay. But the other thing is that, again, so far, I guess we're going to get into this a little more later, but no joint tax returns, at least no joint federal tax returns.
No joint federal tax returns. That's because you can only file a joint return at the federal level if you're married, and we have a law in the books called the Defense of Marriage Act, DOMA, that says the federal government, under federal law, will not recognize marriages between persons of the same sex. So even though if you're legally married, you're not married in the eyes of the IRS.
Okay. All right. So there is another issue. We've got a registered domestic partners couple, California residents, but one of the partners works temporarily in a non-community property state. So now our California partner is going to work in Boston for a period of time. Is that still community property income?
Yeah, one of the things that's most interesting about this new IRS position is that accountants and lawyers are having to go back and rethink all of the laws of community property and how they apply to these unmarried couples who are filing separate tax returns. The general rule is if the married or registered partner, if the domicile is the legal term, really where you live, where you vote, that sort of thing. If both partners are domiciled in California, then their relationship is a California relationship, and California law controls as to personal property. It won't, if you own real property in Massachusetts, Massachusetts law will control what kind of property that is. But wages and earnings are in cash, and that's personal property, and so the law of California should control and make that community property. It will certainly be community property in the eyes of California. It will be community property in the eyes of the federal government, according to the CCA. I don't know how Massachusetts will look at it.
Okay.
That's a conflict of laws question, and that's not a tax question, but a very important legal issue.
Yeah, so obviously, because these days, of course, all the states are fighting over every dollar.
Everybody's going exactly. Every state's going to take the position that it's our income. Whatever position gets the state more in taxes.
And if it's half of yours, half to each of you, then both of you should file a tax return.
That's exactly right.
So
I can see that.
Okay, so let's talk a little bit about the Defense of Marriage Act. And how it works, and then also, I guess there's some states that have Defense of Marriage Acts as well?
Yeah, it's a rule at the federal level that says the relationship will not be recognized as a marriage if it is between same-sex partners. A lot of people think that might prevent the IRS from recognizing the relationship for community property purposes. And a lot of people wrongly thought that's why the IRS refused to recognize the community property rights before this most recent ruling. But it's quite clear that Poe versus Seaborn, the case that they're basing it on, is about property law. It's about property rights. It's not about marriage. So the IRS position, and it should be the position even of the states as well, is that we will recognize the property rights of a couple even if we don't recognize their relationship.
Okay. Now, okay, so we did talk about the same-sex married couples, it should also apply. All right. Now, the federal government at this time, again, does not recognize joint income tax returns for registered domestic partners or same-sex married couples.
Right.
Wouldn't it really be easier if they did?
Well, you're the one who fills out tax returns. You know it would be easier. Everybody I talk to says it would be easier. And in fact, some individuals have taken the position themselves, these are not tax professionals, but individuals, that the Defense of Marriage Act is unconstitutional, and so they're going to go ahead and file joint returns. But strictly speaking, until DOMA is off the books, either by court decision or by Congress, you shouldn't file a joint tax return. Some people have filed separately as single and then file an amended return claiming that DOMA is unconstitutional, and if they owe fewer taxes filing a joint return, they've asked for a refund. And I know of several cases where they've gotten a refund. I don't think the IRS caught the fact that the couple was a same-sex couple claiming to be married. But that's the IRS and its computers that need to look a little more closely.
So anyways, but the point is, that's probably the proper way to do it in a sense, that you sort of follow the rules as the IRS has outlined them, and then if you have a novel position to file an amended return or claim.
That way you avoid penalties.
That way you avoid penalties, and then then if the IRS is going to challenge. Now actually, at least one of these actually did get a decision, didn't it? Or did it?
Well, we have a challenge to DOMA in federal court back in Massachusetts.
Okay.
The federal district court there actually found that DOMA was unconstitutional. So can you rely on that decision and go ahead and file your taxes jointly? The question would be whether that's sufficient authority to rely on. There are other courts that have held DOMA is constitutional. Now, I like the Massachusetts District Court opinion a lot better, and I think it's more well-reasoned, but right now it's been stayed and it's on appeal to the First Circuit. So we don't know how that case is going to come out yet. If you thought you might save taxes by filing a joint return, you could always file what we call a protective claim for refund, in that you're waiting for this case to be decided to see whether or not you're entitled to file jointly. That would prevent the statute of limitations from running on you. But that's a whole complicated process that's taken care of in the Treasury regulations.
And